And I felt like if I wanted to build a strong company and do right by my investors and our LPs, I needed to do something that would work. And so we zoomed out and we looked at what opportunities are there in the multifamily space? Where are these opportunities? What are the markets that have great resilience? What are the markets that we believe will do well 5, 10, 20 years into the future?
Welcome to the I Own It podcast with Ben Reinberg.
All right, we are live from Laguna Beach at the Ben Reinberg I Own It studio today, and we have just an incredible guest. I always get excited when another colleague in commercial real estate comes on. Gets me all excited because everyone knows what I'm passionate about, and that is commercial real estate. And I want to welcome this gentleman, and really excited. We're bringing him in from New York City, and excited to have him. Tom Higgins, how are you? It's a pleasure to have you on the show.
Hi, Ben. Thank you very much for having me on today. I really appreciate it. I'm very excited to get into my favorite topic, and excited for where the conversation takes us.
Absolutely.
There's a lot to talk about.
Absolutely. Can we start by sharing more context on your background and your passion for real estate investing? Sure.
So I'm born and raised in New York City. Mm-hmm. I grew up in a family where both my parents were in brokerage. So I grew up, sitting around the dining room table at night, talking about real estate investing, talking about sales, talking about all things New York City real estate. And I was always really fascinated with kind of, to me, the most intricate and interesting aspect of real estate, which was real estate development. I'd be in a cab with my family driving, up Madison Avenue and looking at the buildings and be like, how do you do that? And it wasn't from an engineering standpoint. It wasn't just from a construction standpoint. I wanted to understand the full picture, start to finish. So I really set out from pretty early age, probably end of high school, to kind of, how do I do that? And there wasn't really a roadmap to how do you build a building, kind of laid out for me. But I started doing what I could in real estate finance in high school, trying to get internships, got into Columbia University, got my real estate license, started studying economics, started interning in the summers at real estate private equity. And I was able to leverage all of that to work for one of the largest private developers in New York when I graduated. It's Rose Associates. For them, I did ground up development and adaptive reuse in New York City. Most notable project was a conversion of a 1 million square foot skyscraper in the financial district that we took, got renovated. It's called 70 Pine. We got renovated it and turned it into 777 luxury rentals. It has a 1-star Michelin restaurant on the bottom and a 2-star on the top that I was lucky enough to be involved with. And then I wanted to get a more national view of what real estate development was. And I went and I worked for the Lennar Corporation, which I'm sure you're familiar with. And I did ground up development for them in New York, New Jersey, Connecticut, and Pennsylvania. And I'm approaching total developed to date about 2,500 units. And now I run Terra Capital, my company's real estate development and operations teams.
That's fantastic. Your company, Terra Capital, is on a mission to institutionalize the lower middle market, mini multi-assets. Share more about the multifamily niche you focus on and the value you're able to create.
Yeah, so as I mentioned, I love development, but the reality is real estate development is very cyclical, and you need to be at the right time to do real estate development. And I felt like if I wanted to build a strong company and do right by my investors and our LPs, I needed to do something that would work. And so we zoomed out and we looked at what opportunities are there in the multifamily space? Where are these opportunities? What are the markets that have great resilience? What are the markets that we believe will do well 5, 10, 20 years into the future? And we developed a pretty interesting strategy that we've been doing now for a number of years and has been very successful. But Terra Capital buys mini multis, which we define from 2 to 15 unit properties, really the smallest multifamily properties around. And typically these properties are overlooked by operators, syndicators, developers. They're kind of forgotten about. It's especially the ones that we take on, because we take on projects that need a lot of renovation and a lot of improvement. And so we're specifically in Columbus, Pittsburgh, and Indianapolis right now. And we go into these markets. We do majority of our buying off market. We talk to mom and pops, and we buy these properties that they probably don't feel are in a good enough shape to be listed on the market. They may have been, I don't want to say neglected, but maybe overlooked for a period of time. And we buy those, we renovate them to the Terra Capital company standards. And then we rent them out, turnkey, and roll them into large portfolios at scale. And Ben, I'm sure you know this, but for real estate operations to work, you need a great team, you need a large kind of footprint. And so at first it's a little bit tricky, but we work hard and build good teams. And then once we get to 100 units, 150 units, it's a really well-oiled machine. And we have a lot of mini multis in the market, and we get to build really great teams.
What criteria do you focus on for your new acquisitions, like your investor materials reference, value-added multifamily properties? What strategies do you focus on for adding value?
Yeah, so we do anything from light to heavy value add. Majority of the improvements we do are interior renovations. So you have to picture these are 1910, 1940 Victorian style properties that haven't been renovated. They have linoleum floors in some cases, carpeting throughout, black or white appliances, no updated cabinets. So we go in, and you can see it on our website. We go in, we take all of that out. We put new engineered hardwood, we put quartz countertops, we put subway tile backsplashes, we put stainless steel appliances. We really make it like a luxury multifamily experience on the interior. And then we try to do our best to maintain the fabric of the neighborhood and just facelift slightly the exteriors, because these are really beautiful properties that we're trying to pass on to generations after generations. We're not going in and doing vinyl siding on everything and kind of whitewashing it. We're trying to maintain the fabric of the neighborhoods that we're in.
You guys do some highly innovative activities in real estate investing, I noticed. Share some examples of what you've done through innovation.
Yeah, so we're at a very interesting time in real estate, and it's like getting more and more exciting. But right now, I think we're kind of at a really pivotal point, and we have been for maybe 36 months. But there's a lot of amazing data that is now available to any real estate investor if you just look in the right place and spend some money. So we buy through big data, property databases, contact information for these mom and pop owners. And we aggregate all that data into really comprehensive data sets. And then we party with third-party VAs, specifically ex-military veterans living in South America, to call these individuals. We also use all the best-in-class email softwares. We do a lot of cold mailers, I believe they call it. So we try to do our best to have touch points directly with the sellers and kind of make the process really seamless.
So from what I understand, you sell portfolios to institutional buyers, and your site refers to a portfolio arbitrage, and some of our listeners will not understand what that means if they're not in the business. Share more about your portfolio exit model and how does it work from an investor's point of view?
Well, I always hesitate to use this thought experiment, but I'm going to do it from two different directions. So
okay.
On one hand, you can have a single mini multi, right? And there are very few people out there that want to buy an 8-unit home. Maybe it's a mom and pop, maybe it's a high net worth individual that's trying to break into it, or maybe it's someone that just wants to do their first deal. That being said, there's not a consistent demand of those buyers in the market. What there is consistent demand for, and we've seen it for a long time, is larger private equity companies and larger institutional investors that want to place a lot of money in high yield real estate, right? So what we do, and those have the check sizes that these private equity companies have been willing to write has been coming down over the years as people get kind of more desperate to do deals in real estate. But it's still very difficult for them to do deals under 10 million, under 20 million, under $50 million, whatever that line is for the specific group. So we try to take these little assets into and add them all up into portfolios that one of the bigger groups can write a check for. And now they have an access to a higher yield asset than if you were to buy just one individual building. And this is kind of the thought experiment that I like to use. How much would you be willing to pay on a yield basis for a perfect 150 unit jewel box in the heart of a downtown area? Okay, now how much would you be willing to spend on a yield basis for 3 buildings in that same downtown on the same street? Now you have 3 50-unit buildings. Now break that out a layer more, right? You have 25-unit buildings, and you break that out a layer more. And there is yield expansion as you go further out. People will demand a higher return when they buy a scatter site. But what we see is that what we can buy our properties for, we stabilize our first portfolio on an 8.8 cap or yield on cost. And we see the individual buildings still trading in the low 5s in our markets. Maybe it's expanded to 5.5 if things are even trading today. But regardless, there's a very big gap in the yields. And that allows us to take advantage of portfolio arbitrage because we can sell our whole portfolio at a 6% yield, a 6.25% yield. It's still a higher yield than the individual buildings, but it's much lower than what we were able to buy all the little overlooked buildings for. I hope that did an okay job at explaining.
Yeah, you did a good job explaining. I mean, it's similar to our funds, the Alliance Medical Property Funds that we do. It's very comparable. It's rolling up a large portfolio, selling it to an institution. And what's behind that, Tom, that we find, and for our audience, if you're listening, is that the institutions, take them as an example, they don't want to do this heavy lifting that Tom and I do, our companies do. And what's behind it is they want to be able to take something on a silver platter, put it in for their investors, whether, it's the teacher who sits in Hawaii from a pension fund that looks for a return. And so it costs and takes a lot of time to put together a portfolio and a lot of expertise. And when you can provide that to an institution because they're just looking for yield, it makes a lot of sense for them. So that's where the value add, and they're willing to pay a premium for it because they know the effort and time and work that goes in. So I love it. And it's what we do as well. And having those assets create a lot of value for your investors. Where is your investment capital coming from? A lot of people always want to know, how do you raise equity? How do you raise equity, Tom? Where is it coming from?
So our first fund was people in our network. I worked for over a decade in institutional real estate and grew a network through that. And I think a lot of the people working at the big development companies see the opportunities that are out there and the arbitrage opportunities, but kind of are used to looking at 5 caps all day, and they get excited about an opportunity for one of their colleagues to go try to take advantage of that opportunity. So that's been great. We also have family investors and friends investors. For our second fund, we've expanded that horizon, and it's really just been a lot of networking, a lot of meeting people, high net worth individuals that we've been having conversations with that listen to us on a show like yours or some other meet and greet, and like the markets we're investing in, like multifamily, like the Midwest, understand the recession resistance and portfolio arbitrage and see the value. And I think people are looking more so than ever for alternative investments. And I think the good syndication opportunities for larger deals aren't really there. So people like you and I who are doing these arbitrage, roll up, value add strategies become more and more attractive.
So you touched on it. Your primary geographic focus is the Midwest, which is accurate, I believe. What drove? I am originally from Chicago, and my headquarters are in Chicago, and the Midwest is part of my fabric. And I want to know what drove you there, coming from the East Coast.
So my business partner, Ray Hyman, he is a Jedi financial wizard, and he's from Cleveland. So we've always kind of had that in Terra's DNA. But when we were creating our first fund, we had been doing a handful of syndications in New York City. And I think we were just a little jaded from the experience that working in a city that doesn't really care for you or want you to be there. Mm-hmm. So when we zoomed out, it was one of the criteria we look for is like, what are some areas that in the long term do we think that we'll have a healthy market? We'll have a market that wants us to be there, where the constituents and tenants in that market have affordable rents, where there's appropriate job growth. It's not over indexed in technology where it could get wiped out during a recession. So, we zoomed out and we kind of looked for all the opposite things of New York City, and Pittsburgh checked that box really strongly for us. The market in Pittsburgh is over-indexed in healthcare and education, and that's something that's really important for us. The job growth in healthcare and education outpaces the national average, but people call it eds and meds, which I'm sure you're familiar with. Columbus and Indianapolis follow very closely behind that in a lot of ways as well. So we really looked at specific job growth metrics to hone into the markets that we're choosing, but we also were laser focused on this affordability question. We want 25% or less of someone's annual income being what they need to pay for in rent. And we believe that creates a healthy market that have tenants that can pay on time, have constituents in the market that are happy and aren't voting in leaders that are going to push for rent control and rent stabilization. And we like the concept that there's high quality of life that attracts big business and people want to feed off of that. And we've seen that a lot lately with some really amazing announcements in Columbus, Indianapolis, and Pittsburgh with new large companies opening, whether it's their headquarters or a satellite office, but they're heavily investing in it. And it's a low cost alternative for large institutions and large companies because the amount they need to pay for a person working at Intel's manufacturing factory that just opened in Columbus is a lot cheaper than if they put it in the heart of LA, obviously.
So let's roll back a year to the pandemic. The pandemic was a very challenging time for landlords. What was it like for you in 2020 and 21?
We got really lucky. And I think we, as a lot of great operators did, day one, hey guys, if you get laid off, email us right away. Let's create a plan. We focused on retention and working with our tenants. Unfortunately, some tenants or residents try to take advantage of the opportunities. And I think that's just the nature of where the world is today. But on the large majority of them were very open and communicative, and we were able to get through it very well. We worked with our lending partners. We have conforming loans, and we did, mortgage deferments and things like that to kind of make it so it was low drama for us and our investors. But I think it was just a proactive approach allowed us to be successful. But another part of it is that we pick markets, and our rental base, right? We're in the mini multi space. So we're about 25% to 30% discounted to luxury rents. So our tenants are the 22 to 35-year-olds that are essential workers for a large part of our renter base. So we didn't have as many layoffs as maybe some other people are in some other industries in some other cities. We have a lot of people that worked at universities that were doing webinars to teach their students. We had a lot of people that were able to work from home if they were in an accounting job or something like that. So we had a good index of tenants that were kind of essential, which I think is a part of our strategy and has only become more a part of our strategy as we have grown our portfolios.
I believe deal volume is down considerably recently in multifamily. Has that been the case for you as well? And are there new strategies you're going to look to implement to adjust to what's going on in the world right now?
So
with supply chain issues to rising interest rates, what are you doing out there?
Yeah, so no strategy is invincible, but a lot of these kind of things that we're experiencing now is what we were talking about and thinking about when we created our strategy. You know, in 2019, this was kind of for me and for maybe a lot of my colleagues in institutional real estate. Everyone's like, how is this sustainable? So we really set out with the strategy from the beginning to kind of be recession resilient, be resilient in these spaces. And so majority of our deals are off market and like we talked about earlier, are heavy value add. So if anything, the fear, the kind of concern that people face about the future of the economy brings sellers in our space to the market. We're not trading our assets by calling CBRE, Cushman Wakefield, or JLL and saying, hey, some institutional group come buy us, or hey, we need to buy this 300 unit building from you. Like those can't trade because of the structural break between the cost of debt and the yields that are existing in the market, as I'm sure you well know. But we are really at very high yield properties to where debt is still accretive for us for a very long way. So the main thing for us is really finding people willing to sell their mini multis. You know, we don't do single families. We don't do any owner occupied acquisitions. We're really only buying things that are investment properties for people, but they haven't really been managing them to top of market for many years. So when they hear about an issue in the economy, it tends to bring people to the market rather than make them go away. So our deal volume has picked up substantially in the last 9 months about.
So obviously you can look behind me. The name of my show is I Own It. Okay. And I'm not just talking about real estate, Tom. I'm talking about you owning every aspect of your life. Can you share a recent example where you realized you had it wrong and didn't own it fully?
Well, this is a bit of a cop-out answer, but I have a 4-month-old child, and I significantly underestimated how difficult that was. I was like, well, if everyone does it, it can't be that hard. And I was dead wrong. It is truly incredible how difficult being a parent is. And I was humbled and shocked by that. But you know, the other answer is I think you'll appreciate this. I've been training jujitsu for many years, and I still get on the mats many times, even though I'm a higher belt and more skilled and things like that. And I just get crushed by that new 220-pound college wrestler first day doing jujitsu. And I still like question all the 6 years I've been doing it and the results from that. So I am humbled on a weekly basis. So it keeps me grounded and allows me to keep moving forward with sleepless nights of having a 4-month-old child.
What's the best way to engage with you, follow you? And are you on social media? Is it the website? Yeah. Give our audience, how do they get a hold of Tom Higgins?
So the best way to get a hold of me is probably through our website. If you go to our website, you click on the leadership tab. Our website's usaterra.com. And I'm active on LinkedIn and Twitter. And I'm also active on Bigger Pockets. I write a lot on the forum, so you can find me there if you look up Tom Higgins and Bigger Pockets. But Twitter is Tom C. Higgins. LinkedIn is on the website profile. And I really started enjoying, and Ben, you might actually enjoy this too if you're not already engaged in it, but there's this Twitter community called #retweet. I don't know if you've seen this, but it's a pretty cool community that I've started enjoying engaging with and been growing my content on there lately.
That's great. No, that's great knowledge. Yeah, we looked into that as well. So we're gonna wrap up with our 3 questions. And how old are you, by the way?
29.
All right. Well, you have a lot of space between the question, but we're gonna ask it anyways. We ask all our guests. So in our studio of couch, I lay down on the couch. I said, Tom, close your eyes, get on the couch, lay down. Go back to when you're 16. So you're 29. You've had some experiences. We are in a challenging business. There's a lot of variables, a lot of learning curve, and you still have a huge horizon to learn. I've been in this business for almost 3 decades. and there's always things you can learn. So you're 16 years old. At 29, what would you tell yourself that you learned that you could teach yourself and say, you know, what to look out for, advice you would give yourself now knowing what you know 13 years later?
You know, I think about this actually a decent amount, and I don't know why I do, but I do. I think the real answer to that question is treat everyone with dignity and respect. It's been enormously powerful for me. And I think I came out of some large institutions and some large groups that I don't know if there was a bit of a disconnect, but sometimes I think residents and tenants can start to look like just numbers on a page. And we forget that like these are people's lives, people live here. And when I changed the frame for myself a year or two ago and like just took a step deeper, it's been really powerful for me professionally, but also just like mental state. Just take a step deeper, work with people. You know, you can't compromise all the time, but like people are people, treat them with respect and dignity, and it goes an enormously long way.
That is so well said, and you should be proud of yourself for doing that, going a little bit deeper and figuring that out. And here's the beautiful thing about that I could share with you and our audience is when you do that, okay, and you show that respect factor and you become a good listener, which is so important. What ends up happening is those that you're speaking with or interacting with will contribute to your life. You might learn something. They might impact you. They might put you in a better state. And that better state, maybe you found a deal or a thought, or you're able to create a relationship with a new lender, whatever might be out there for you that you're creating. And when you can become a good listener by providing that respect factor, and because what ends up happening is when you understand, Tom, the truth and what someone's telling you, you open your lens to learn a lot of growth. And so that was a real well said statement. So you should be very proud of yourself because for a young man, that's a tremendous insight into how human nature works. So it's our last day on earth. God forbid. It's you and me. All right. It's our last meal together. What are we eating and what are we drinking? Your choice.
Well, I'm going to start with Camus because my wife recently was gifted some and we had it and it was phenomenal. My as a push present. And so I would start with Camus and then I would go down. I think, oh man, it's a great question. I'm a steak guy. So I'm going to go with just like as perfect of a filet as you could get. I would say ribeye, but I'm going to go filet. With perfectly pureed mashed potatoes, and that's it. You know, that's the meal.
That's perfect. Being a Midwestern guy, I'm all over that. I love it. In our studio, we have a grand piano, a drum set, and 6 electric guitars. And if you come in studio, and welcome to come Laguna Beach and hang out and chat, love to have you here. If you could bring in any band or musician, they can be living or deceased, Tom, to play us a song, who are you bringing in?
100% Chris Stapleton all day long.
Oh, love it. All right. What song is he playing for us?
Tennessee Whiskey.
Okay, perfect.
Yeah, I listened to him on Joe Rogan's podcast a number of years ago, and it was like eye-opening to me. This is superstar, amazing country singer. And one of the things he said that has stuck with me, resonated with me so strongly was like, he doesn't go on tour without his family. Like he doesn't split up his family. He doesn't do that. He's like, they come with me, and that's his life. That was his hard line. And I love that concept that you can like be whatever you want to be, work hard, succeed, and not distance yourself from the people you love. So,
oh, well said. Yeah, that's always a struggle with entrepreneurs, and you know that, especially with the traveling you do.
It's hard.
It is a challenge.
Yeah,
and it's balancing. That's why be the best version of yourself, and that will allow you to get through those days where you're separated from your family. So, Tom, I just want to thank you for coming on. It's such a pleasure to hang out with other commercial real estate colleagues and you're quite a talented young man, and you should be really proud of where you've come so far, and you have an incredible future. And I'm really excited to connect with you and watch you grow within the business. It's very gratifying to me when I see wonderful people in our industry just consistently just elevating and leveling up their game. So thank you for sharing your knowledge today. We appreciate it.
Yeah, thank you very much. I really enjoyed our conversation.
So if you're interested in the Ben Reinberg I Own It podcast, drop kick that right-hand red button and click subscribe. Feel free to click the like button as well. The more likes we get these great guests like Tom Higgins on, and we can drop and share great knowledge to more people. So share the wealth, as we say, and let us share our knowledge. So click that like button. Also, to follow me personally, go to benreinberg.com. You can follow me on all social media platforms. We're experts in health, wealth, relationships, commercial real estate, business, mindset, you name it. We'll touch it all. And then if you're interested in commercial real estate, feel free to go to my website, alliancecgc.com. That's alliancecgc.com. Feel free to peruse around there. We have a brand new fund, the Alliance Medical Property Fund. If you're a credit investor, you're interested in investing in commercial real estate, feel free to check it out. We'd love to have you. Anyways, Tom Higgins, what a pleasure. Great seeing you. Hang on a second. And everyone, thank you for joining us today. We appreciate it on the I Own It podcast, and we'll see you soon.
Thank you for listening to the I Own It podcast with Ben Reinberg. To hear our past episodes and connect with Ben, visit benreinberg.com.